Significant volatility marked global financial markets on Monday, March 31st. Indices from Tokyo's Nikkei 225 and South Korea's Kospi to France's CAC 40 registered notable declines. This worldwide market agitation correlates directly with the anticipation surrounding the upcoming April 2nd announcement of new U.S. tariff policies, an event termed Liberation Day by President Donald Trump. In the United States, Wall Street exhibited pronounced intraday swings. The S&P 500 reversed a 1.7% morning loss to close 0.6% higher, while the Dow Jones Industrial Average erased its own deficit to gain 1%. Conversely, downward pressure on key technology stocks contributed to a slight decline in the Nasdaq composite. This turbulent trading finalized the worst quarterly performance for the S&P 500 in 2.5 years. Such sharp, often contradictory, movements within trading sessions have become characteristic, reflecting deep uncertainty regarding the precise nature of the forthcoming tariffs, described as reciprocal, and their potential repercussions for inflation and economic growth. Much remains unknown about the specifics of the policy set for announcement. Concurrently, assets traditionally viewed as havens strengthened. Gold prices climbed, briefly exceeding $3,160 per ounce in U.S. Treasury bond prices increased, consequently lowering their yields. The 10-year Treasury yield fell to 4.21%, down from levels near 4.8% in January. This indicates a capital flow towards perceived safety amidst the prevailing economic ambiguity generated by the impending policy shift. The global market landscape is currently defined by this reaction to anticipated government action, conducted in an environment where critical details remain undisclosed. This absence of clarity surrounding the tariff specifics forms the nucleus of the current market disturbance. Economists at institutions like Goldman Sachs attempt to quantify this uncertainty. Their analysis projects potential reciprocal tariffs averaging 15%. Consequently, they have adjusted forecasts, anticipating heightened inflation and diminished U.S. economic growth later in the year. This assessment leads them to elevate the probability of a recession within the next 12 months from 20% to 35%. Their reasoning points directly to lowered growth expectations, eroding confidence levels, and administrative statements suggesting a readiness to accept economic hardship as a consequence of the policy. These expert projections, disseminated widely, influence investor risk assessment and contribute to the prevailing caution. Further complicating the outlook, strategists such as those at Morgan Stanley posit that the April 2nd announcement may not provide definitive resolution. They suggest it could function merely as an intermediate phase for ongoing negotiations rather than a conclusive event that stabilizes market expectations. This perspective implies that policy ambiguity and associated growth risks might persist beyond the scheduled date, extending the period of instability. The operational concern extends beyond the direct impact of finalized tariffs. There is documented apprehension that the uncertainty itself could induce a paralysis in spending by both households and businesses. Such a freeze, driven purely by the lack of predictability, could negatively affect economic activity, potentially undermining the solid pace observed towards the end of the previous year, irrespective of the eventual tariff details. Within this environment of broad market unease, individual equities exhibit varied reactions, sometimes influenced by factors beyond the immediate tariff question. Technology sector stocks, including notable names like Tesla and Nvidia, faced downward pressure. Tesla's decline, resulting in a significant year-to-date loss, is linked contextually to perceptions surrounding its CEO's political activities and resulting protests targeting the company. Nvidia's pullback occurs amidst ongoing discussion regarding its prior valuation relative to profits, a common theme for large-cap tech stocks recently. Conversely, others displayed resilience or were driven by distinct corporate events. The home loan servicer Mr. Cooper registered a substantial gain following acquisition news from Rocket Mortgage, whose own stock subsequently fell. Berkshire Hathaway showed strength, its performance noted alongside public knowledge of its substantial cash reserves, a potential indicator of perceived value scarcity in the current market, according to some interpretations of its investment posture. Simultaneously, the market debut of Newsmax saw extreme volatility and a massive price surge, necessitating multiple trading halts, highlighting pockets of speculative activity detached from the broader economic concerns. Yet this narrative of pervasive gloom and defensive positioning stands against potential alternative outcomes following the April 2nd announcement. The documented market anxiety is predicated on forecasts and assumptions made in the absence of concrete policy details. Should the unveiled tariffs prove less stringent than current investor fears anticipate, for instance, if specific trading partners like China face no additional levies beyond existing ones, a significant market rally could materialize. Such a development would represent a recalibration, where established pessimistic expectations are unmet by the operational reality of the policy. Conversely, the potential for a more severe outcome remains a distinct possibility. If the Liberation Day measures align with or surpass the most negative projections, market declines could accelerate significantly. The critical factor in this scenario involves the reaction function of businesses. Should corporations perceive the tariffs as sufficiently damaging to future profitability and stability, prompting tangible actions such as workforce reductions, this would likely trigger a more profound equity sell-off, validating the deep-seated concerns currently weighing on market sentiment. Therefore, the immediate trajectory hinges directly on the substance of Wednesday's policy release. The market's present state reflects a pricing in of substantial risk. The actualization of that risk, or its mitigation, will determine the subsequent direction. Underpinning these potential divergent paths is the inherent complexity of the proposed reciprocal tariff mechanism itself. Calculating equivalent burdens across disparate economic systems, incorporating elements like value-added taxes, introduces significant operational challenges and potential points of contention with trading partners. This lack of a clear, universally accepted framework for reciprocity adds another layer to the prevailing uncertainty, making it difficult for businesses and investors to accurately model the potential impact even conceptually, let alone based on specific rates. Furthermore, the explicit statements from administration officials indicating a willingness to tolerate economic pain in pursuit of policy objectives fundamentally alter the risk calculus for market participants. This suggests that traditional feedback loops, where negative economic indicators might prompt policy adjustments, may not function as expected. Consequently, markets must factor in the possibility that policy could persist even amidst signs of economic distress, prolonging potential downturns or instability. This dynamic reinforces the significance of uncertainty, not merely as a precursor to policy, but as an active economic variable. The very possibility of disruptive tariffs, coupled with ambiguity about their scope and the administration's reaction function, is sufficient to influence behavior. Investment decisions may be deferred, hearing plans put on hold, and consumer confidence eroded, creating economic headwinds independent of the tariff's eventual imposition or severity. Thus, the observed market behavior, the sharp swings, the flight to perceived safety, the sector-specific pressures, reflects a complex interplay between anticipation of specific policy details, assessment of the administration's broader strategic posture, and the tangible economic effects of prolonged ambiguity. Extending beyond domestic market fluctuations, the synchronized sell-offs observed earlier in key Asian and European indices underscore the global scope of these concerns. The declines in Japan's Nikkei 225, South Korea's Kospi, and France's CAC 40 reflect international apprehension regarding potential disruptions to established trade flows and supply chains should the U.S. implement broad reciprocal tariffs. This anticipated policy shift is thus perceived not merely as an internal U.S. economic adjustment, but as a potential inflection point for international commerce and economic relationships. The resulting strategic ambiguity compels international corporations and governments alike to reassess their positioning and exposure. Contingency planning for various tariff scenarios becomes a necessary operational reality, influencing investment location decisions, sourcing strategies, and diplomatic engagements far beyond the immediate horizon of the April 2nd announcement. Ultimately, the day's closing figures on Wall Street, the S&P 500 finishing up 0.6% at 5,611.85, the Dow Jones Industrial Average climbing 1% to 42,001.76, while the Nasdaq Composite edged down 0.1% to 17,299.29, encapsulate this state of heightened tension and unresolved questions. They represent a market balancing immediate, divergent corporate news against the overarching, globally significant uncertainty emanating from the awaited policy clarification. The operational reality, then, is a global market framework held in suspension by the gravity of unresolved U.S. policy intentions. Observed phenomena, the sharp oscillations in equity indices worldwide, the demonstrable flow of capital towards traditional havens like gold and treasuries, the divergent analytical forecasts projecting both recessionary risks and potential relief rallies, all trace back to the informational vacuum concerning the specific architecture of the reciprocal tariffs. Clarity, or the confirmation of worst-case fears, hinges entirely upon the substance of the April 2nd pronouncements. Until that moment, uncertainty itself functions as the dominant force shaping economic behavior and market positioning across the international system. Thanks so much for watching. If you enjoyed this analysis, and be sure to give it a thumbs up and hit that subscribe button for more geopolitical insights like this. I love hearing your thoughts, so drop a comment below and let's keep the conversation going. Share this video with anyone interested in deeper perspectives on current events. Until next time, stay informed and think critically. Thank you.